Good afternoon, everyone, and thank you for joining us today. My name is Erica Vokey, and I'm the Marketing Communications Partner for the National Center for the Middle Market. Because today's event is a collaboration between NCMM and Fifth Third Bank's Business Transition Advisory Team, part of Fifth Third Private Bank, I wanted to take a moment to share a bit more about each organization before we get started. The National Center for the Middle Market is a collaboration between the Ohio State University Max M. Fisher College of Business, Chubb, and Visa. The center is the leading source of knowledge, leadership, and innovative research focused on the U.S. middle market economy. The center provides critical data, analysis, insights, and perspectives to help accelerate growth, increase competitiveness, and create jobs for companies, policymakers, and other key stakeholders in this sector. Fifth Third's Business Transition Advisory Team is a private bank team solely dedicated to preparing business owners financially and personally for their business transition. With 75 plus years of combined experience, this team provides deep education and expert advice across a diverse range of industry sectors. Throughout today's webinar, we will provide an overview of the Owner Transitions in the Middle Market Research Report the NCMM and Fifth Third Private Bank recently collaborated on. We will have an in-depth discussion with several representatives from Fifth Third who will share additional perspectives and insight on middle market owner transitions. We'll end with a Q&A session with all of our speakers. Before we get started, I wanted to share a few guidelines and housekeeping items for this session. All attendees are muted with videos off for the duration of the webinar. Please submit any questions for our presenters at any time during the presentation using the Q&A section at the bottom of your screen. I will be monitoring the questions and sharing them with our presenters for discussion in the last 15 minutes or so. Please note that this webinar is being recorded and will be uploaded to the center's website for future on-demand viewing. Live captioning is available throughout this webinar by clicking the closed caption button at the bottom of your screen. And now I will turn it over to Doug Farron, the National Center for the Middle Market's Managing Director, who will kick off the session.
Thank you, Erica. Well, it's a pleasure to be here with you all today for this discussion about a very important topic, which is the process of business owner transition in mid-sized companies. I'm going to set the stage, as Erica mentioned. I'm going to first start by talking a little bit about the middle market, the way that the center defines it, and some of the statistics around these businesses in the United States. And then I'm going to share some of the key insights from the research collaboration that we completed this past summer with the Fifth Third Private Bank Advisory Team. And then, as mentioned, we're going to bring in some experts from Fifth Third to have a conversation around some of these findings, bringing in their expertise and their perspectives on what they see as they work with a lot of middle market companies throughout the country. So if you're unfamiliar with the NCMM, as the overview explained, we are in our 12th year. We're located here at the Ohio State University Fisher College of Business, and we really specialize in middle market research, insights, and thought leadership. We do that through the lens of really two things. One would be growth opportunities for mid-sized companies, and the other would be looking at the key challenges that they face, given the fact that they're so unique. They're obviously bigger than startups and small business, but they're smaller than the Fortune 1000 or what are commonly referred to as enterprise companies. So in our 11 plus years, we've taken a look at all the key issues, challenges, again, from the perspective of mid-size business owners and mid-size business leaders. Probably our most well-recognized piece of work is the Middle Market Indicator. It's a survey of 1,000 businesses that we conduct semi-annually, and it's in its 36th wave. So we've been continually tracking the performance and sentiment of the U.S. middle market for close to 10 years since the launch in April of 2012. But we also look at topical research areas ranging from talent management, globalization, innovation, working capital management, and particularly this study, which we're going to share today, on the owner transitions process. And finally, I would say outreach and engagement is a key for us. We do that through a network that's comprised of our sponsors, partners such as Fifth Third, who help us with these types of research projects, and a whole network across the country of other organizations who are also dedicated to helping see that the vitality of the middle market is fully served and recognized. Just as a reminder, there are different definitions out there, but since our inception, the National Center for the Middle Market defines mid-sized companies as those with annual revenues between 10 million and $1 billion. We know that that's a huge range. So typically in a lot of our research, particularly such as the MMI, where we have a large sample of companies, we can do subsegments, lower middle market, 10 million to 50 million, for example, upper middle market, 100 million to $1 billion, for example. This number is always changing, but roughly around 200,000 businesses in the United States fit that revenue description. They're in all industries and all segments and all parts of the country. There's not a city, town, metro area that you'll visit or go to where you won't find middle market companies. And using this definition, it really does represent the middle third of the US economy, both from the standpoint of private sector GDP, as well as in employment. And the one I like to point out on this slide, we'll have to double check if this still holds true, but if the middle market were its own country, it would be the 5th largest global economy, which is pretty stunning, and what makes this work so important. So based on all this data we've collected over the years, what do we know about middle market companies and what makes them so ripe for this process of transition? Well, for one thing, we know that they're fairly long longevity in terms of being in business. Close to 40 years on average is the longevity of the average middle market company. Upwards of 90% of them are privately held businesses. You're not going to see many middle market companies traded on stock exchanges. Most of them are privately held, which again, different types of ownership, including family ownership. Close to 40% of these companies are family owned, which creates other opportunities when thinking about transitioning between generations and so forth. So these are all good reasons why Fifth Third and the NCMM collaborated to explore this topic a little bit further. So we came together in the spring. We worked with the Business Transition Advisory Team to develop a survey. We actually talked to 300 businesses, but more importantly, we talked to 75 individual owners regarding this process of transition, before, how they prepared, how long that took, during the process itself, and then finally what they did after the business transition. Over half of the individuals that we surveyed were family-owned businesses. And again, 3/4 of them were either in the 2nd, 3rd, or 4th generation. And some of those key questions we asked: motivations for selling, length of time in the preparation, some of the challenges and emotions faced. So I'm going to spend the next few minutes kind of going through some of the key insights before I bring in 2 guests who are going to talk with me about the real ramifications of what these findings represent in the middle market. So our first insight: there are a number of different sales drivers that create the need for transition or drive transition. So if you look at the left-hand side, 13% of our respondents actually said that they're not looking to necessarily retire or exit the business world entirely. They're actually looking for new business opportunities. The next highest response at 12% were those that saying they really want to take out cash out of the business, but they also want to maintain involvement and some control. And finally, others were looking for either investment capital or felt that it was the right economic conditions. So the timing was right. And if you look farther down the list, you'll see retirement and or full exit. So, our hypothesis from the center was perhaps these owners were ready to, buy the yacht and sail off into retirement or join the golf club and spend their days that way. But really, a lot of them are looking to reinvest. And as we look to the right-hand side of this chart, you'll see that is the #1 destination for the proceeds of the sale. Close to half of these owners are saying they're taking the proceeds and investing it, or 1/3 of them are saying we're actually going to enter into an entirely new business, while another 3 in 10 are using these proceeds to purchase new assets or perhaps increase a reserve fund or do something with their family along the lines of trusts or things of that nature. So a lot of different things that are happening in terms of the sale proceeds. The next thing we looked at was preparedness. So this process takes a while. It's not where the owners wake up one day and say, you know what, I'm going to sell and I'm ready to just, go through that process and it's going to be done quickly. What we see are varying lengths of time in terms of both the preparation as well as the process of the sales transaction. And a majority of the companies told us that their preparation process was between 1 or 2 years. That's going to vary based on, the robustness and accuracy of their books and their financial record keeping and a lot of those different things. But that's where the bulk of the companies were saying that timeline stood for them. And then when we look at the actual sales process itself, a majority of the transactions, about 2/3 of them, wrapped up in 12 months or less. So at the end of the day, as a business owner who decides I'm ready to sell, it's going to take typically between 18 and 24 months from the start of that process until the transaction close. What were the goals? Well, in the bottom left, you can see the number one goal was maximizing valuation of the business, followed closely by making sure that there was access to the right types of advisors and advice. And then, as I mentioned, with a majority of these being family-owned businesses, over half of our respondents said that they want to ensure that there is a family legacy that continues. But speaking of advisors, who were those top advisors that were consulted during the transition? We can kind of think of them in two buckets. From an internal standpoint, you've got the C-suite executives and other top leadership teams within the company. You also have in-house attorneys in some cases who are integral to that process. But then externally, the most commonly cited resources for consultation were external lawyers and law firms, as well as investment banks. So again, we'll kind of talk about this a little bit in our discussion, but there are a critical role that advisors play to owners, because essentially most of them may go through this only once or twice in their entire career. So that advice becomes critical. This process is not without its challenges, though. So we asked some questions around the emotional aspect. What were these owners feeling at the beginning, during, and post-transition? You could see at the far left, prior to the transition, kind of an equal amount of negative and positive feelings, things like anxiety, worry, other negative emotions, being overwhelmed, frustrated, uncertainty, right, around this, because it's just not a process, as I mentioned, that's undertaken very frequently. And then as the process kind of unfolds over that 1 to 2 year time period, in most cases, a lot of those feelings were replaced by very positive emotions, happiness, relief, a sense of accomplishment and fulfillment, which is ultimately the goal for most of these owners. As far as challenges that were frequently cited throughout the sales transition, the number one, about 3 out of 10 companies said that getting a true assessment of the value of the business was their number one priority, followed by a quarter of the companies saying that employee communications represented a challenge. These things often can happen in the background, and there'll be instances where that becomes a very tricky issue on maintaining the right amount of employee communication while the process is ongoing. 2 other top challenges were dealing with tax issues as a result of the sale. And then again, with that family ownership component, dealing with various family issues throughout. Our final insight is on the post-sale perceptions, and I'm happy to report that at least for the owners that we spoke with and interviewed, a majority of them felt very, very good about the satisfaction, the process, how everything unfolded, and feeling like they really not only sold at the right time, but got a great deal. So again, close to 90% felt like the timing was right. 61% felt that their sales price was somewhat or much higher than their peers. So obviously they look around and see at other businesses, maybe in similar industries or, in their geographic area. So they're able to compare, even though there's not a lot of this type of data publicly available for middle market companies to consume, they do get a sense, at least intuitively, that their sales price was better than their peers. And over 3/4 of these companies ultimately were very satisfied with the sales negotiation. Now, that's not to say that this isn't or has the potential to be a very exhausting process as well. So deal fatigue was something that was called out. It's very critical and ultimately can play a very key role in determining the ultimate happiness and success in terms of how the seller views the transaction. So that is some of the highlights. I just wanted to go through those to set the stage. I will mention that this report, as well as others, are all available on our website. If you haven't seen it already, just go to middlemarketcenter.org. You can download the Business Owner Transitions Report in PDF form. And I would invite you to go look at that, as well as any other resources that we have at the center. And with that, I'd like to transition over to a discussion at this time. So I'm going to bring in two guests today. So joining me for discussion on business owner transitions is Frida Rockman, as well as Rob Shipper. So Frida serves as Managing Director of the Strategic Client Development at Fifth Third Private Bank. She leads the Business Transitions Advisory Team with the intent to optimize the personal and financial readiness for business owners considering a transition. And then Rob Shipper is the Managing Director and Head of Investment Banking at Fifth Third Commercial Bank. He is responsible for supporting the strategic direction of investment banking and is a member of the capital markets senior leadership team. So Rob, Frida, glad you can join me today and welcome.
Thank you, Doug.
Thank you.
So we're very excited about this work. It was a pleasure working with your teams on, number one, developing the questionnaire, exactly what we wanted to do. And then, of course, since we released the findings late summer, actually sharing it and talking about it. And so I had the pleasure of attending one of your events out in California, which was excellent. And so, yeah, I just wanted to walk through some discussion around a little bit of these findings, but really more importantly, what the both of you see when it comes to business owner transition, since you're living in this world pretty much day to day. So Rob, I'm going to start with you first. M&A in general has been pretty much uprooted. I mean, it's been a roller coaster since 2020 and the pandemic and everything that's happened. Could you just start out by describing what the current M&A environment looks like and what is the outlook as we head into 2023 for private business owners who might be thinking about exiting or transitioning their business?
Sure. And you're right, there's a lot of change going on in the market right now. And when you have change, right, you have companies need advice. And so, our business at Fifth Third, the investment banking, is primarily M&A related. So sell side, buy side capital raising, predominantly for middle market business owners. So the direct audience you're talking, your study focused on. And at any one time, Doug, we've got about 40 or 50 transactions in the market. So have a good pulse on what's going on. I'll give you a punchline to your question, and I'll back up a little bit. But I think the market today is cautious. But I'd say my forecast for next year is more cautiously optimistic, and we'll get to that. But leading up to the fourth quarter of this year, you described it accurately, right? It's been a roller coaster. So the 10 years leading up to the beginning of the pandemic really was a bull market for M&A and for sellers. It was a very good seller market. You had a combination of an expanding U.S. economy. You had a tremendous amount of capital coming in, and predominantly financial sponsor capital. And then you had an aging baby boomer, right? So the catalyst towards transitioning businesses really gave a really nice environment for owners to evaluate strategic alternatives. And then, we thought that ride was going to continue. The pandemic, hit, and in March of 2020, I'm going to use some song analogy. So it was REM at the time. It was the end of the world as we know it. And really there wasn't any M&A activity. So we were kind of advising our companies, how to stay afloat and survive. So then you get to December of that year and it's Bon Jovi, Living on a Prayer. So things were better, right? But still fighting to survive. And then I think it took, everybody by surprise of how quickly with the liquidity pumped into the market, things turned for the better in 2021. And so that the music theme, Nothing's Gonna Stop Us Now by, I know you know this, Doug, but that was Starship back in 1987. And the market it continued to be pretty strong despite the, if you watch CNBC, that the equity markets were collapsing, but our private M&A actually was still pretty strong up until about September, October of this year. So my last song analogy is Blondie, bringing back to the 70s. I know, but I don't know, which is, half the folks, believe that it's gonna be a soft landing. We'll we might have a recession, but it'll be a minor one, and we'll kind of get back to normal. I think that's where my view is, Doug. But there's, again, there's a coin flip in terms of what that outlook looks like. So that when I say it's cautious is because there's uncertainty in the market.
Right.
And so when I think about what are the things that we need to have to bring us back to what I'll call a normalized M&A market. So it's visibility on our economic outlook. And I think we're getting there, but there's still some of that uncertainty. It's a return to normalization in our financing markets. There's a predominantly risk-off environment right now for financing, which is impacting transactions. And then what I'll call valuation equilibrium. We had, last year, because it was such a strong seller's market, we had a pretty hot valuation environment. That the valuations, we'll get to this a little bit later, but the market is still strong. So good companies are getting fair prices. It's just the premiums people are paying are based on that uncertainty are a little bit lower. So that we'll get back to normalization. That kind of takes, a quarter or two. So my view is we'll continue to have visibility, that uncertainty kind of in the first quarter of next year. It'll start to solidify. We'll have a better foundation as we head into the second quarter. And I think the remainder of next year, I think we're going to be back in business, right? Because we've got capital and we've got a really resilient U.S. economy, and our business owners have great businesses.
Yeah, that's a great segue into my next question for you, Rob, which was, we saw in the data that valuation, getting a maximum value is the number one goal, and also might be the hardest thing for the owner to actually truly assess. And, multiples and things like that are important for those looking to exit or maybe find a growth partner. In your experience, what can the business owner do to best maximize that valuation in a potential transaction?
I think you're right. The valuations, people love to talk around the water cooler. How you interpret that is it can be multiple different ways, but it is important. I'd say at the end of the day, it's in the top three. It probably, I guess your study said it was number one. I think when you dig deeper, it's probably two or three, but it is a key consideration. And I'll use the axiom, Doug, in terms of, great businesses are bought, not sold. Meaning, companies that really do well, have really good outcomes, it's because they've built a great company and have run a good process to get to that outcome. So I'd say a few things is to position yourself for that. Is one, build a strong foundation to evaluate those alternatives. And, we tell our private companies, think and act like a public company. And what I mean by that is have a board of advisors. It can be informal, to have budgeting and 3-year financial plans, review the depth of your management talent. So get the store in order so your foundation's strong. The second is from a business model. So what is a buyer buying, right? They're buying, two things, that business model, the competitive advantage of that. So think about that moat. So do you have IP or do you have a leading market position? So what makes your business different? And how do you protect that and accentuate those opportunities? And then that leads to, the other key consideration of what a buyer is buying. They're buying growth, right? In terms of that future cash flow. So that we talk about a growth roadmap, so the ability to articulate what that growth opportunity, what that growth roadmap looks like for your company. That could be, acquisitions, it could be adding new product lines, it could be a whole host of things. And you've validated some of that. Companies have validated some of that, but some is on the come. So being able to put that story together. So I think those three components are really critical in terms of maximizing that outcome.
Great. So Frida, I'd like to talk to you about the personal side. So you and your team, spend all day working with these business owners directly. So could you share what owners should be doing in advance of a potential transition to prepare as best as possible?
Sure, absolutely. And I appreciate you having us today on the line. In addition, in case anybody's wondering, the score is still 0-0 for the World Cup. So you haven't missed anything. But that being said, so my team and what I do all day is work with owners across the country in a variety of industries. And what we see is that owners are extremely busy day to day running their business, as well as the fact that if there's any type of transition or transaction that's looming, that tends to be a big distraction and focus of attention as well. So the ball that's dropped most often is the one around personal implications. At the end of the day, all of these companies are privately owned, right? And there's an owner, there's a family, there's key employees who are the lifeblood of this particular company. And so what happens with all of those individuals? And that's exactly what we focus on and have an understanding around, is that there needs to be a lot of attention paid to what's the end point. You start actually with the end in mind. Where are you going and what do you want to accomplish? The majority of owners that I see have a lot of tax sensitivity, right? And are concerned about the check that they're going to be writing once there is some sort of major transaction that's taken place. And there are a lot of different buckets of tax too. There's two main buckets. There's the tax that you're used to paying every single year, and then there's tax again once you pass away. We're in a really unique time frame right now, given where tax laws are, and those will change at some point. They're going to sunset at the end of 2025, where we have exemptions right now. So owners need to be proactively thinking about what will happen when there is going to be a transaction or transition. There's a lot of optionality that can come into play on how you want to maybe optimize the structure of your company, or what you intend to potentially do with proceeds, if you're worried about the next generation. And so that conversation needs to start sooner rather than later, and way far in advance of there being any type of letter of intent or some serious offer that's on the table. So way before you have an absolute, you need to start with the abstract, I'll call it. Mm-hmm. And it's very important to have key folks around you who do this day in and day out that can give you some good advice as to help you get there.
Yeah, so the data that we found in the research in terms of the timelines for preparation, did that resonate with you? And what are some of the factors that may influence that, either shortening it or maybe potentially increasing it in your experience?
So it's not a surprise to us that owners say that the company is ready, right? We see that all the time. The company is ready. But when we dig in and we are focused on the actual owners themselves, they are underprepared. And they tend to spend maybe less than a year focusing on their personal preparation, or they've come across factors once the deal is inked after the fact, right? And then they ask us, they say, well, the deal's closing next week. What am I supposed to do? I say, cash the check. Right? And then we'll have a conversation afterwards. But it's important to start thinking about these things way far in advance, more than 12 months, start 24 months, 36 months, 48 months. There is no such thing as too early to really start to tease out what you may be thinking about. So that's the main thing that I see that's been consistent with our data, is that owners are not spending a lot of time, and it's for no other reason than they haven't gone through this before, right? They're an expert in their particular industry. You may have an attorney that sits within your counsel at your company, right? Or you may have some sort of attorney that you work with on a regular basis, or a CPA. And those are great advisors, but there are people who focus exactly on this time frame of what's happening in someone's life and the life cycle of the company. And it's important to have those experts also on your team so that you can really intentionally prepare.
Yep, that's great. So, Rob, I want to talk a little bit about private equity. I mean, this has become a pretty big player in middle market M&A, and for a lot of people, it could be a kind of a scary thing to think about. I love the client that you had at your event who kind of talked about, the PE companies doing this for a living, and the business owner, maybe being not as equipped for those types of discussions. But it is an important buyer, right? An important growth partner for private middle market businesses. So share, if you could, what advice you might give to business owners who are considering working with a private equity partner as part of this transition process.
No, it's a really good question, and will continue to be increasingly more important. I'll give you a couple of stats before I address your question. Is in our deal flow. So we're predominantly that middle market. You showed 10 to $1 billion. Our sweet spot is in that 50 to 500 million range. So clearly that middle market business owner. The majority of our exits are to private equity. I think it's somewhere around 65% are sold to private equity, and the remainder to strategic buyers. So very predominant in that middle market range, and one of the reasons, and we believe only going to increase. I think the stats are today maybe 6% of private businesses are owned by sponsors. We think that'll triple, over the next decade. And what's driving that is the mega trend of capital coming into the private markets. So today there's a little over $2 trillion of uninvested, we call it dry powder, but uninvested capital. It's been raised by private equity, and that's all the way starting from venture up to later stage groups. But $2 trillion, and that is up 10x over the last decade. And we expect that trend to continue, maybe not 10x, right? But the amount of capital continue to flow in. And I think that's been really good, right? Because it provides business owners with a lot more options than they had in the past, as well as with that, when you have the supply, right, with a finite amount of demand, well, guess what? Valuations go up too. So it's benefited the valuation trend of having that capital come in. But back to your questions, what do you need to think about? Well, I'll start with what I'll call truism. So one truism of what we know today is that almost every private company is getting called on by financial sponsors. They're extremely good at business development. And so that we know, right? And it's probably multiple calls a week, and I expect that to continue. The other kind of truism is most, not all, but most business owners think that private equity groups are evil. To your question around scary, maybe evil's a little bit too hard, but I think they're misunderstood in terms of. But the other truism, and you hit on it, Doug, is that they are economic beast, right? Is their business model is to make a return for their investors, no different than a public company, right? We want to be good stewards to our communities, of course, but we have to. They're set up to be to drive returns for their stakeholders, and so private equity is set up to be the same. So we need to understand that going in of what their motives are. They're not, most all of them are not operators, right? So they don't run. They're not coming in to run the business, but what we tell our clients is don't confuse that with not owning the business. So they're going to be, running those board meetings, with management, making the day-to-day decisions, but things do change. So to your question, because what are some things to think about? I think one is be proactive, not reactive. And what I mean by that is since you're going to get those calls, don't react to a bid. You talked about, the survey talked about being prepared, right? So that's key, whether it's on the wealth side or the business side, be prepared. So have your strategic objectives for the business as well as for the family, kind of outlined, and those can change, right? But so when you get that call and they're throwing out a number, rather than reactive to it, does it fit with the objectives that you've kind of laid out? So be proactive. The other thing I think is really important, and we strive to do this with our clients, socialize with private equity, outside of the process, get to know them. There are many different, since there's so many of them, hundreds of firms, right? They come in many different flavors, right? From where the segment of the market they focus on. So do they write, $10 million equity checks or $100 million equity checks? Are they focused on a certain industry, or do they have an operations bent? There are a lot of different flavors. So understanding those constituents, and starting to meet some, so the business owner can ask questions, right? What went well? What didn't go so well? And so to understand, what drives them, motivates them outside of pure economic return. And we do that in many different ways. One is what we call non-deal roadshow. We'll take clients up to New York, or have people fly in and just have them meet them, maybe 2 years ahead of a transaction. So to socialize. And then I think the third is back to the planning, right? So if is run a process versus just following a trend, following a valuation, and have it be competitive. One, it'll drive a better valuation, but really drives better success outcome of getting to a transaction. Your survey talked about the length and the emotion. It's very long. It's a very emotional. So you want to make sure you're doing that within a competitive process that keeps that timeline going.
Yep. Would there be like any red flags that you might call out that would say like this should be like walk away immediately, or something to be extremely
I had one
about?
like we had during a management presentation, which is like the week before final bids, a private equity was meeting with the owner saying, the week after close, I'm going to take your office and take your job immediately. So that was probably a red flag. He did not, that group did not get invited back for their management presentation. But I'd say, yes, there are plenty of red flags, right? Because while, some private equity may be evil, it's not about being evil. It's like what really aligns with what's most important to a business owner, right? So maybe it is, having somebody that really understands operations because they want to grow in a lot of different ways, or they want to take the business internationally. And so maybe that private equity or could be a family office we didn't talk about, but that aligns with a certain objective that really resonates to a business owner.
Yeah.
And again, if you set out, we had one really nice business that they really important for them to stay active in the community. So they said, we don't want to move the company. And so we knew that on the front end, and we're able to articulate that to investors, right? This is really important, and this is part of the deal. This business is going to stay headquartered in this town, and we're going to continue to grow it there.
Yeah. So Frida, based on what Rob just described and what you had mentioned earlier about the advisors and the importance that they play in this process, who are the certain types of advisors? We saw some of it in the survey data as well, but can you share that kind of list of who should be at the table and why they're important throughout the process?
Sure. So I'm just going to mention some of them. And really what I'll say is you would think there could be too many cooks in the kitchen on this process, but to Rob's point, it really is important to run a full process and have folks that are experts, right? So that's the first place that you start, is having that group of folks who have done this, who have represented companies in the particular industry, who understand the space inside and out, who can be your eyes and ears. But in addition to that, when it comes to the personal aspects, you want to also make sure that you have proper legal counsel. And what I mean by that is trust and estate planning. People often tend to think of just doing wills, right? But there's a lot of proactive financial planning that can be done ahead of a transaction, like I talked about, leveraging those experts. So making sure that you are visiting that and talking about how your company is structured, making sure that you have your CPA as part of that conversation. Mm-hmm. We sometimes see, so we're never in the business of dislocating or dislodging advisors that have been part of a company. But what we do see is sometimes companies will outgrow who they have as an expert and need to add someone else, right? So maybe they need to have a CPA firm that also operates in a similar type of size space. In addition to that, when it comes to the legal side, usually we'll see that there'll be a transactional attorney, an M&A expert of sorts that's in there that's also able to represent the company. So I will call on also the fact that it's very important to have, I mean, I know I work in this industry, but you need to have your wealth advisor as part of this conversation as well. It needs to be a cohesive conversation. Oftentimes, our owners are afraid to talk to their bankers. They think that they're going to negatively somehow disrupt the relationship that they have with an organization, that it'll negatively impact maybe a rate that they have with a loan, or they're going to be disclosing something that they shouldn't. What I'll say is that transparency with those advisors can work to your benefit, right? They're going to be able to advocate both for you and for your company, which also then leads to who do you bring under that umbrella as you're walking through that process, and who do you share information with and who do you not? And Rob can probably speak to that a little bit better. Some of our owners are very concerned about privacy, as they should be, and also about keeping data confidential. We've seen some of that with hacking situations come about as well. But starting that conversation with your initial team that's an expert in the space is critically important, and making sure that you're having folks that are advocating for you on the personal side is equally as important as you walk through this process.
Right. Yeah, that's great. So let's look ahead out into 2023 and beyond. And I'll just pose this to both of you. Given all the uncertainty that we've talked about today, I mean, market volatility and things that are just going on in the macroeconomic environment, are you seeing any potential industry sectors or places that might be extremely favorable, or where investors are basically going to, or are there things that stand out over other industries, for example?
Yeah, I'll start. It's not going to surprise anyone in terms of when there's uncertainty in the economy and a perspective around an economic downturn, that the herd mentality of investors, right, flock to things that are more defensive. So we're certainly seeing the impact of both inflation on companies and the cyclicality risk is changing where investors are focusing on in the near term, and obviously that will change. So they're looking at things that are more defensive. Healthcare, is always a great defensive industry. Yeah, we do a big business in healthcare services, and that really, I wouldn't say it hasn't been impacted, but it hasn't been impacted as much as others, and the valuations, frankly, have held up in that sector, but because of that. I think beyond that obvious, right, of companies that in an inflationary environment that are can pass on cost, or not as capital intensive, that the inventory swings impact their returns, is what I'll call that K-shaped recovery is coming out of the pandemic. Is investors are looking for what are the winners in that next wave of the economic growth. And so, clearly, things that are, the whole tech enablement wave is, and so it's not just software or SaaS. It's how do you embed, a tech enablement within, a consumer business or industrial business. And a good example of that, Doug, is Express Car Wash. I'm sure many, if not all, the folks on the phone have taken their cars through one of these, they're all named something different these days. That will change, but an Express Car Wash where you have a subscription. Well, you think about that is that's not a new, car wash is not a new phenomenon, right? But that tech enablement of taking labor out of that business model, leveraging that technology, leveraging a subscription-based business model for car washes. It's taken that business and created a craze, right, of investors can't get enough of it. So it's really driven up valuations and that desire to come in and really scale those businesses. So I think it's going to be certain industries in the near term are going to be more in favor, but I think that in that medium long term, think about more in terms of what business models are going to be more defensive and in favor going forward.
Frida, and I'm going to invite again any attendees. If you have a question, please feel free to submit. We're going to open it up here in a few minutes to some Q&A from the audience. But Frida, what should owners think about after the transition process itself? Like, what does life look like? Which I know it's going to depend because they all have their own motivations and interests, but kind of generally, what is your advice on the post-transition process?
Well, just like your data shows, the majority of these owners that are out there are not retiring, right? A lot of our owners say that they're going to take a pause and take a break and they're exhausted. I see that effectively pans out for 3 to 6 months, and then there's another venture that's around the corner. So life after exit is very much linked to life before exit, and making sure that you have a full appreciation for maybe what that looks like. So if you're going to continue to be an entrepreneur, definitely create some flexibility there from the financial aspect of how you're structuring things, and setting them up from a legal aspect as well, so that you're going to be protected and insulated, and you can go on to do whatever your heart desires. A lot of our owners too, after the fact, most of them are not going from lifestyle A to lifestyle B, although I'll say that there are a lot of pilots out there and a lot of people who don't want to fly commercial anymore. So that tends to be a common theme, and I don't blame you, because I'm on a Delta plane all the time. And as much as I love Delta, I would by far rather not have to fly commercial. But what I'll truly say is that happiness is related to how much time and effort you really put into thinking about that and what life is going to look like. If you just put that on pause and don't pay attention to it until after it's done, there sometimes, even though there's a big check that's been deposited, there can be some sort of depression from the fact that maybe you aren't the primary owner of your business anymore, or you're not seeing the folks that you've worked with every single day for the last 20 years or 30 years. So you have to be mentally prepared for that, and that takes as much work as it does to set up the company in an optimized way to transact.
Yep, got it. Okay. With that, we've had a few questions that have come in. I'm gonna address the first one here. So, or I'll just actually throw it out to both of you. So the question is, describe how a transition might be different from a middle market company that you typically deal with than maybe a smaller business. So maybe below 50 million or less revenue, EBITDA, smaller employee base. Are there any differences or special considerations that might make those two processes different, unique, or somehow other differentiated?
Yeah. And so I'll start. I'll talk in generalities because I guess the answer is it all depends, Doug, right? In terms of the business model, we've got some healthcare IT companies that, have 5 million in revenue, but it's recurring revenue, and that business is valued at 8 to 10 times revenue. So that's an exception, a unicorn. But in terms of, let's say it's similar sector, but different size of companies. Yes, there are different aspects to that. And in general, the bigger, as your company gets bigger, the valuation multiple does expand. I mean, it gets higher. So and data supports that. So if you had a $2 million EBITDA company, let's say an industrials company, that average multiple might be 5 times. But if that same company's 15 million to EBITDA, that multiple may be 8 to 9. And the main 2 reasons around that are risk, right? So smaller companies are higher risk. So if you lose one customer as a $10 million revenue business versus, and it's got concentration, that's a big impact. And so that higher risk impacts how an investor will look at that. The second is depth of capital. So bigger companies attract more capital, and that provides some leverage there. I think on the, if you're a smaller business, think about, strategics are very active for small businesses, as well as, sponsors of doing what we call an add-on. So they are looking for, $1 million business. They love those businesses if it fits with their existing portfolio company, because their sponsors model is how fast can I grow that and then exit in 3 to 5 years. And then the other things to consider, maybe if you're smaller in size, is structure. So some of whether it be a seller note or some way to bridge a gap in terms of valuation, if you're trying to exit the business.
Yeah. Rob, does size also increase the complexity potentially of the deal? Because I'm thinking about things like multiple locations of facilities or a bigger supply chain, or you might be international, for example. Does that create challenges?
Yeah, it's really, it's counterintuitive because the bigger companies are actually easier to sell than the smaller companies, and that's due in part because they're set up. Remember that comment about, act like a public company, even if private company is if you're a smaller business, a lot of times, you don't have, reviewed financial statements. So it's on QuickBooks or an Excel spreadsheet. It's just, when you get in there, it takes a lot more effort to get things organized so you can tell the story well relative to bigger companies that have kind of, they're just operating a little bit easier to get. It's just less risky in terms of that.
Yep.
Getting the diligence and telling story.
Gotcha. Frida, this next question I'm going to put your way. So what are some common regrets or maybe lessons learned that you see from owners as they have completed a transition? Is there anything that they wish they would have done differently? I mean, our survey said that most of them are very happy and thought that the process went fairly well, but I'm sure there has to be some regrets or things along the way that they think they could have done differently or done better.
So there's a couple of things. Obviously, I've honed in on this throughout the conversation, but that they didn't start early enough when they were preparing, right? And that comes on both sides, but most definitely on the personal side. So prepare. I'm going to keep focusing and hammering on that because it's very much important, even if you don't think you're going to do anything. Because guess what? 100% of these privately owned businesses are going to transact at some point, right? So I'm going to hone in on that. Another one is sometimes there's some disappointment from what happens to the company culture after the transaction has happened, right? Because these owners bring in the lifeblood of culture to their company and with the key people that they have there. So it's making sure that you also very much vet out the cultural fit for your company, for who's going to take that over and be able to carry that flag for you. And sometimes there's not a whole lot of emphasis until after the fact because there's shiny numbers that are put in front of what's going to happen with a deal. So it's also critically important to just make sure that you're paying attention to that with your potential suitors and who the next folks that are going to be coming into the organization.
Okay, great. So we have a real life scenario here. We have an owner who submitted a question. So I own a professional services firm, and it seems that professional advisors don't know how to value these kinds of firms. The default seems to be the value of existing contracts, and that is a rolling value that doesn't seem to look to the future. Offers for my firm are roughly half of all the estimates, and it looks like the time to make money is while I own the firm. Selling seems tough when outsiders don't understand how we make money. Any advice for this owner?
Yeah. And I'm sending this individual a private note with my contact information because it sounds like we're going to need more time to dig into it. Maybe they're going to the wrong buyers or not articulating the story well. But this comes up pretty regularly, right? Or another example is I've got a big capital expenditure and I'm about to sell a company. Do I buy that piece of equipment, right? Because I'm not going to get benefit. I'm going to have a huge expense up front, not get benefited for it, down until the future. But it's articulating what that business model is and why those contracts. Yes, there's cash flow, absolutely, in terms of the value of the cash flow coming off of those today, but they're not buying contracts, right? They're buying a business. And so a lot of what we're doing as investment bankers is we're digging into the financials, but we're telling a story, right? And since we know the industries, we are industry aligned, and I think that's really important versus a generalist is by understanding, and we've got experience in contractors, but understanding that industry and the nuances of that industry, and how do you tell the story to make sure that and that you're going to the right investors that understand that end market and can value it appropriately. But I'll shoot my contact information. We can follow up.
Okay. We've got a few more minutes here and we just got another question. So what percent of deals do you find are seller finance versus buyer finance? And are the multiples different for each of those two scenarios?
So I'll hedge that answer because it's one is specific to the M&A market. So in a really strong, what I'll call sellers market, so very good M&A market, and for, let's say companies above 10 million of EBITDA, you almost have zero seller financing. And you only bring that in, whether it's seller financing or whether it's an earnout, to kind of bridge a valuation gap it's really just hard to define. But strong market, rarely have seller financing. As you get into companies that are smaller in scale and have less alternatives to sell for various reasons, it might be an industry, it might be a lifestyle business versus an ongoing business. Is that's where you do see more seller financing from strategics. And it varies, but that could be a third. Frankly, it could be 50% of a business. Similar to the question before, though, really dig into that is what are you giving up? Because once you sell, right, you're giving up that operational control. Is it worth it?
Yeah. One more question before we wrap up. What are your thoughts, either of you, on transitioning to an ESOP from a founder-owned business?
So I have a strong opinion on this,
Okay.
Which you may like or you may not. When you're thinking about an ESOP, it's very important about thinking about it in the right way and for the right reasons, meaning that you have a strong team who's going to be able to carry this business forward. A lot of owners get enticed by the tax implications or the tax benefits, rather, of how to structure a company ESOP. We have experts that are at our organization that work with this all day long, and it is pretty complicated topic. I'm just going to advocate because I've seen ESOPs get I don't know if you would say this, they're basically unwound, or you wind them down a couple of years out after you've started them because it didn't maybe pan out the way you intended it for it to. So what I'll say is, if you're going to explore that option, it really has to be about the people. It has to be, you have to have such a strong mindset that the team that you have on board is going to carry this business forward, and they're the future of your organization. So if you're going down that route, make sure that you're fully exploring all of your options, but I can't emphasize that enough. So Rob, I don't know if you have another
and there was a follow-up question just around valuations of ESOPs, and are they kind of the same versus let's say a private equity? It goes back to it depends, right, around the ESOP. I agree that if you've got a sellable business, ESOP, but just the structuring and flexibility down the road, does not benefit the tax advantage of a sale up front, most often than not. However, if there's certain industries or companies that there just aren't logical buyers where a sale to an ESOP may make sense. So I think talk to your advisors. The valuation, because you're selling, the ESOP itself is a third party, so there shouldn't be any valuation discrepancies. There's just a discrepancy around liquidity. Are you getting that all up front, or are you getting that over time, and what are the risks related to that timing and uncertainty?
Well, I would love to continue this conversation, but we're at the end of our hour. So I want to thank you both, Frida, Rob. It's been a great discussion. I learned an awful lot. It's been very interesting and hopefully informative for the audience that attended today. Again, I just want to encourage people too, this video will be available for on-demand viewing. So if you'd like to share it with colleagues, or others that weren't available to attend due to a conflict outside of the World Cup or otherwise, please have them do so. So I appreciate the time, and thanks again. Look forward to continuing our partnership.
Thank you so much. Have a great rest of the day.
Great. Thank you.